Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, as well as our co-host, Skyline Corporate Communications Group, we're very pleased you have joined us for our next live presentation from Reed's, the owner of a portfolio of handcrafted natural beverages. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome Norman Snyder, Chief Executive Officer of Reed's Inc., which trades on the OTCQX Best Market under the symbol REED. Welcome, Norman.
Thank you. It's great to be here. Good morning to everybody in the audience. This is quite unusual speaking because I'm looking at myself rather than a group of people, which I'm not accustomed to, but I'll do my best. My presentation, I wanted to do something a little different. Rather than go through the typical investor slide deck, which we've had, and I've given probably hundreds of presentations, and I encourage you to check it out. It's on our website, www.drinkreeds.com. If you scroll to the bottom, there's an investor section, and you can find the presentation there, and I think it supplements this well. But rather than do that, I wanted to pick a specific topic, and a topic that I think we've all kind of gone through. I've been in this business for several years, and the last three have been something that I've never encountered. And I'm on several local groups and associations, and as well as all my compatriots across the country, whether they be fellow brands, suppliers, co-packers, distributors, etc. We've all shared the economic and other events that have impacted us, and some more than others. But I want to spend time on how that specifically impacted Reed's and what we're doing to work our way out of that. So with that said, let me get into the presentation. And I'm going to wait, although you can submit questions when I'm speaking. I'm going to wait to the end to really answer all those questions. So let's get into the presentation. Real simple. I'm going to cover quickly the history of Reed's, which is pretty interesting. And then the strategic assessment is what I made when I first came on and what I thought I should do. And as a result, put together a 3-year plan. But then this thing called COVID, or the pandemic, came on, and it really threw everybody off tracks. And we really have worked hard over the last 18 months to 24 months to really get back on our plan. And then I'll share with you the updated plan and what we've done to combat the impact of the pandemic, and then risk and opportunities associated with it. And at the end, we'll open it up to Q&A. So as many of you have seen, Reed's is over a 30-year brand. I think if I count, it's like 36 years, and Virgil's clearly over 30 years. The brand was founded in Southern California in 1987. The Virgil's brand was acquired in 1999. In 2006, Reed's went public, and then the new management team led by me came on in 2020. And you can see on this line, and this is also in the investor deck, various milestones, whether it be retail additions or product intro launches or other significant events in Reed's. Our portfolio is really two brand names, Reed's and then Virgil's. Now, Reed's, we have an alcoholic and a non-alcoholic portfolio, and our non-alcoholic portfolio consists of ginger beers, and we have extra and zero extra, which are the two top selling, and we also have original, which is less ginger, strongest, which is more ginger, and then premium, which we sweeten with honey and pineapple juice, no cane sugar. In 2020, we introduced our line of ginger ales. We have a full sugar and a zero sugar, plus we have mocktails, Surely Tempting, and Transfusion. And then on the alcohol side, we have two product lines, our mule lines. We have a classic mule and a stormy mule, obviously, that emulate popular drinks. The Moscow Mule, well, I'll say the Freedom Mule, and the Dark and Stormy. And then we also have a line of hard ginger ales with 4 flavors, mango, pineapple, coconut, strawberry, watermelon, and cherry limeade. And then on the Reed's portfolio, we have both full sugar and zero sugar. Our full sugar and both our zero sugar are anchored by our award-winning root beer, but we also have a cream soda, a black cherry, and an orange cream. And then we do a limited edition swinglet program with our Bavarian Nutmeg Root Beer. Then also, we consider part of Virgil's, but it's somewhat of an orphan brand, Flying Cauldron, which is a butterscotch beer. And we also do a limited edition version of that in the swinglet. And then we have our portfolio of candy. So quite a diverse portfolio. So coming in and doing my initial assessment, and not much has really changed from this, but when I took a look at the company, I thought there are 5 or 6 things that we need to focus on and do. Continued our revenue growth, and Reed's has really never had an issue with growing the top line. But we need to reduce our trade spend. And that's obviously the money that we spend to promote our brand. Includes slotting, it includes any off invoice or any sort of promotional program, and really get our arms around that and bring that down to a more manageable level. Probably, though, the 2 most important items were improved gross margins, which my view were woefully low, and then our freight costs, which were woefully high. The last part was to manage our SG&A, which, in my opinion, didn't have a lot of fluff in it, but nevertheless, you don't want that to get out in front of you. Now, a significant component of SG&A, obviously, is the cost of being public. So we put together a 3-year plan, and we broke it down into like 3 buckets: repair, which was in 2020, grow in 2021, and expand in 2022. And I wanted to highlight some of the, there's a lot here. I wanted to really highlight the key items. In 2020 is really getting our co-packer network organized and really implement strong QC protocols to make sure our product was the best it could be and it was consistent. And then from a product standpoint, both sales and marketing was launching our ginger ale, which I think we did successfully, and it's one of our fastest growing and largest part of our portfolio today. In 2021, although we started in 2020 from an ops perspective, we want to drive margin improvement, and that's something that's going to continue for as long as I'm here, and reduce transportation costs. The same goes that way. From a sales perspective, we wanted to optimize our team to make sure that we had the right coverage. Obviously, we're a small company, and it's a big country to cover. From a marketing aspect, we wanted to really emphasize our Virgil Zero Sugar campaign and the growth there. And then our e-commerce platform, which as a result of COVID was something that I saw consumers really moving more towards. 2022, which was our expand mode, we're going to continue with the margin optimization and the transportation optimization. From a sales perspective, it was filling out our DSD network, and then marketing, it's really handling innovation and new products that we bring on. So that was really back when I started in 2020, how we laid this plan out and what we were going to do. 2020 was actually a good year for us. We grew in our sales channel because most consumers spent a lot of time in the grocery and natural channel. Consumers were more focused on known premium brands that had a healthier bent to it, and there was really no inflationary pressure. And there wasn't really a lot of disruption. Obviously, more consumers were buying online, but if you look at what we did, and if you go back to my objectives, top line growth was 19.1% versus a 6.4% decline the prior year. We reduced trade spend down by 2.8%. Gross margins went from 24 to 31. Shipping and handling came down from 283 to 276, and we cut about $2.6 million out of our SGA. So we're feeling good. And really coming out of COVID, it's my real thought was, what are really going to be the changing purchasing patterns by consumers? And that's where I thought about the online. 2021 came on, and we continue to have solid top line growth. I mean, we dipped down from 19.1 to 16.8, but we really saw, and obviously there was improvement in trade spend because of COVID. We didn't really have to do a lot of trade spend, so that came down further to 9.3. But where we went backwards was on gross margin, and we had inflation across every aspect. I've been, like I said up front, I've been in this business for a long time, and every year, 2 to 3 vendors take modest price increases. Over a 4 to 5 year cycle, everyone's done it. You take a price increase, nobody bats an eye, but every supplier started taking price increases, and several of them multiple price increases. We also saw transportation rise pretty rapidly, and you could see it went up to $3.95 a case. Now, We built our SG&A because of if you remember, going back to the prior slide, I talked about sales team optimization, really wanted to expand and get into the alcohol sector and into additional markets. 2022 came along. The inflation didn't abate. The transportation went up and then came back down. So we saw some light. But if you look at although we had continued top line growth, it slowed down to 8.8%. The category as a whole, although dollar sales were up, you've seen that volumes are down, and that's impacted virtually every company. Obviously, there's a few outliers that are doing well, but then our trade spend went up because of price increases to cover the cost of our inflation. It was brutal. Every time I got an email from a supplier, I dreaded reading it because I know what it was going to be. Sorry, Norm, we have to take our price up. Our prices went up. We're just passing on our increase to you. Nevertheless, I think in the aggregate, all of our goods went up by about 25%. Now, clearly, we couldn't take pricing to cover that. There's only so much consumers are willing to spend, and you can see that in today's numbers where volume is down because consumers are buying less because pricing has gone up. So there was only one thing to do. How do we combat inflation, and what do we do to bring our costs back in line and drive margin expansion and also bring our transportation down? We did have some disruption in 2021. I think people that were buying cans, that was the clear frenzy. We lost a little bit of business in the first quarter because we couldn't secure cans. We saw some increases in lead times, but we never had an issue other than that can where, hey, we couldn't get something. But obviously, we had to be better at planning. But we started to see that slow down in 2022, although the inflationary pressures really remained. And at that point, we really had to make a decision. And for folks that are in this business, do you continue to sell your customers, although your margins have really gone backwards and burn more cash? Or do you select certain customers that you're going to service and then ignore others? Well, we chose to continue. We chose to continue to service all of our customers because if you don't and you get discontinued from retailers, they tend to have long memories. And it's not like at the DMV where you forget something and the nice lady says, "Oh, Mr. Snyder, you can go back to your car and get that document. And rather than go to the end of the line, just wave to me and you can come up and we'll finish your business." It doesn't work that way. You have to get back in line, and it can take several years to really get back into distribution. And we did not want to lose what we'd worked hard at for years. So we chose to stay in business, to bear the brunt of the inflation and work our way out of it. And we had done several things, incidentally, that if we didn't have done, would have been a lot worse. So, the best way, and what I told the team, the best way to describe it is we're on a flight going across the country and we had heavy turbulence and the captain comes on and says, remain seated, put your seatbelt on. And everybody's really uncomfortable with it. And that's how it was. And then at a certain point, we just hit that clear air and the seatbelt light went off and the captain came on and said, "You're free to move about the cabin." And I feel like we're back to that. We're spending time on growing our business. We're spending time on how we're going to get more efficient. We're spending time on how to reduce cost. And rather than, deal with all these uncertainties and deal with surprises and deal with price increases. Good news is, I saw in the paper today in the journal that inflation continues to come down in June. We've seen that, and I expect to see price decreases on several of our inputs, but we've done a lot to really mitigate our exposure and to really bring costing down. So if I go back to my original plan, the updated plan is on pricing, trade spend, COGS reduction and margin improvement, freight and handling, operating costs, and as we've told the markets, we intend to generate positive cash flow and modified EBITDA in the second half of this year and moving forward. And as a result, we'll be able to increase our marketing investment and increase our sales coverage. How do we do that? Well, pricing optimization, we really took a look by channel. And what we wanted to do to really get is consistency and to not leave money on the table and to be able to more efficiently run promotional programs. So we really took a look at that. How do we drive margin? How do we be consistent? And how do we not leave money on the table? And as a byproduct of that, we also looked at what's our best route to market in terms of servicing our customers and maintaining pricing integrity. Trade spend, that was from day one. And what we've done is we've improved systems to really monitor and track how we're doing. But also we broke it down by customer to put a detailed plan together, maximize what our ROI is, really look to draw a lift, improve our brand exposure, and all the other things associated with it. So we're getting the maximum bang for our buck, but really keeping it minimal. And we've been pretty successful there. The big thing, though, and it continues as I've said up front, it's really our COGS improvement, margin improvement, and transportation. And what we did is we really went back and started from square one, looking at purchasing efficiencies, whether we have to work with new vendors or come up with other ideas. A great example is with our labels. We downsized the real estate on it without really sacrificing the branding, and we're able to take about 40% out. We looked at formula optimization. We've worked with, again, it's about partners, and you can't do this alone. We worked with our ginger supplier, and we've come up with a better way to process our ginger to take costs out and to store and transport it. We also, as a byproduct of the recent backlash with erythritol, are taking erythritol out of all of our zero sugar products. As I mentioned, we did a lot up front. We spent, during this whole COVID thing, we spent 6 months really trying to optimize our formula, and we reduced our erythritol from 12 grams to 7 grams and saved a substantial amount of money. We're all high-fiving one another. 2 months later, the price of erythritol doubled, and all that work we did went away. So we went back and we really tried to rework formulas to save money, to what makes sense, what's going to give our consumers the best bang for their buck. We also, as our volumes have gone and we've tried to be in the right place to produce, we've negotiated better tolling fees on our with our co-packers, and both outbound and transfer freight. We've really worked hard to reduce, and I'm going to talk about that in a freight slide shortly. Actually, it's the next slide. So we really worked at network optimization. We brought a third party in to really evaluate where we need to be, where are our most heavily traveled freight lanes, and what's the best way to do this. And I think and we've targeted and we'll hit $3 million in annual savings. But I think the best is look at this map, where we were and how much capacity we have until where we need to be. And we've realigned our co-packers to service those freight lanes, to be in the right location, and also minimize what we'll call intra warehouse freight, where we used to be, we had a can producer and a bottle producer, and we had to aggregate all of our inventory to third-party distribution center. Now we have co-packers that can do both bottles and cans or in closer proximity. So we've really reduced that type of freight. But if I go back one, the other thing we've done is working with our customers to get all of our customers to take full truckload orders. And if full truckload orders can't be accomplished, we have implemented a surcharge. So we've really worked hard to bring down both our transportation and our warehousing. SG&A, we've targeted $3 million in annual savings there. We've had a hiring freeze. We've reduced our travel. COVID's helped with that because people are accustomed to using Zoom and doing video conferences. So we really took a hard look. Where do we need to be? But the two areas that I talked about when we start generating positive cash that we want to get back into is we've reduced our sales cost. Looking at data, looking at broker fees, looking at point of sale and other collateral, and reduce marketing costs, media, our sampling team, and other miscellaneous things to really try to drive cost savings. And I think we've been largely successful in doing that. But it's necessary to really get back to cash flow break even and modified positive modified EBITDA. And I think we're on a good track to do that. The risk, what are the risks? Well, the economy and consumer sentiment. I mean, I think with the warm weather, consumer sentiment has kind of changed favorably to beverages. But that's a very fickle thing. And so far it's been positive. Inflation, knock on wood, it's going the right way, but obviously that can be very disruptive. The supply chain seems to be intact and has adjusted. But again, geopolitical events can impact that, things that are really outside our control. So we watch that very closely. Luckily, the majority of our items are sourced domestically, so we're somewhat insulated from that. Transportation costs, although it's been moving favorably, obviously things can change there. And then execution, obviously it's on us to execute against that plan. But at the same time, there's a tremendous amount of opportunities. We're focused on categories where there's growth, categories that we're strong in, and categories where we can expand our coverage. Gross margin improvements obviously generate more cash, and that's something that we're very focused on. But we need to return to making marketing investments. We need to get additional channels. I mean, there's a lot of growth in channels that we're not in. For example, the convenience channel, but we're growing in the club and growing in the mass market channel as well. And then service rate improvements. Obviously, the better we can service our customers, the better we can provide full loads on their orders. We get into a good cadence. We also keep our shelves full, and it kind of feeds on itself. So these are things that I see as crucial to the business. Very simple, but this isn't a complex business. It's really about having the right plan, about having the right execution. Obviously, if I go back to what I said, all of our kids, 2021, we were blindsided by the impact of COVID with inflation and transportation, and it really kind of threw us off. And, as I said, we weren't alone. I mean, the big guys were hurt. Obviously, they can withstand it a lot better than we can, but a lot of small companies took it on the chin. I mean, I know if people saw yesterday, Anchor Steam is going to close its doors, and obviously, a lot of their business was on premise and locally in San Francisco, and COVID had a big impact on that. So we all faced it. We fought through it. It was brutal, but we never gave up hope. We never kept fighting. I think we've got a great plan moving forward, and it appears that we're on the right track to get there. So with that, go to the fun part, Q&A. And I think I'm supposed to read the questions, and then I'll give the answer. And I always like it when I get questions. So thank you for those that did submit questions. Nothing's more disheartening is when you give a presentation and you look up the question board and there's no questions. So thank you for that. Can you discuss some of the initiatives you put in place to reduce transportation and warehouse costs? Absolutely. Being in the right place to service your customers. So we did that study. Where do we need to be to minimize our customers at the cheapest rate? So we've done that, and we've reconfigured where our co-packers are. We've also eliminated a lot of that transfer freight by having co-packers that can produce all of our products. So there's less moving of products around, and we're also using those co-packers as distribution centers rather than third-party distribution centers that save money. And then also we're working with our customers, and most are very understanding of taking full loads on orders, and those that don't take full orders, we're putting a surcharge. So we're really bullish on this. We really see a big opportunity. Back when freight wasn't as high as it was, although we knew this was an issue, it doesn't get highlighted as much. But when freight went through the roof, obviously this becomes a much larger problem, and something that we've worked very quickly on and very hard to improve. Second question. Has the number of retail channel stores carrying Reed's beverages changed in the past few years, and what is the outlook for additional channels? It has. We've tended to grow them, the number of retailers, and a lot of it's been because of product introductions. Ginger ale was a big reason, and we added a number of stores. We're looking at it by channel. Obviously, we've expanded with Walmart and had success there, with Target, with Costco and BJ's. And then now we're really focusing on both as a mixer and with our alcohol portfolio on premise, liquor stores, and other retailers that sell alcoholic beverages. Obviously, we also want to expand our online presence, and then also, we really need to find the right product that resonates with the convenience channel and our alcohol portfolio. Maybe that. We're working on different packages to satisfy that channel, but Reed's historically has not had a very large presence in convenience. Next question. This morning, the announcement of Ms. Dang to the board. Can you elaborate on Ms. Dang's relationship with REIT, specifically D&D, Source of Life Holdings, and how REITs will utilize that relationship? Well, D&D just put a major investment in REITs, and part of that investment involved a board seat. We're really excited about D&D and Ms. Dang joining the board. One of the things that they're very bullish on is exporting REITs to Asia. And we've already begun that process. Obviously, they have the business contacts and connections, so we're excited. We think that's an opportunity of growth. We've just started in the UK producing locally, where they're using a concentrate model rather than finished goods, shipping finished goods. So as we perfect that, we're probably going to expand into the European Union, but that'll be a basis and a model which we use to go to Asia, which will really keep us, from a consumer standpoint, price competitive, but also will cut down on our costs and allow us to grow. So we're looking forward to that. They have a lot of experience with U.S. companies and done a number of investments. So it's a great relationship, and we're looking to import products that they may have affiliations with that make sense in the United States. What are your milestones at the end of the year? There's several. Obviously, the key ones are driving top line growth, reducing our trade spend, improving our margin, which we've done through the first quarter, and we expect to see that to continue. Driving down transportation costs, the same thing in the first quarter, we expect to continue. But the key thing is really to get to cash flow break even and positive modified EBITDA. That's really the key. All those things lead to that, and that's my number one goal. But obviously, we need to accomplish all those other KPIs to achieve that. Next question. Hi there. Is there a plan for relist on the primary NASDAQ market? Yes. We have to satisfy certain criteria, and that criteria is really a result of being profitable, because we have to have a certain minimum net equity. We don't want to go out and dilute ourselves to do that. We evaluated that last year. We chose not to do that, and that's why we were delisted from NASDAQ. But the plan is to really do it organically, to drive profitability, and to be in a position to be relisted. Can you share your thoughts on your valuation and what the catalyst for a revaluation of REITs? I think our valuation is embarrassing, but also not fair. Historically, if you looked at multiples on beverage companies, I mean, we're a $60 million company. It's frustrating, but I think the catalyst for a revaluation is profitability. I think the markets and investors will view us differently. REITs has never been profitable in its history. That's something, when I joined, was my main driver, and it goes back to that initial 3-year plan. We were thrown off track by the reasons I shared with everyone, but I think we're back on, and I think that's it. And I believe that at that point, people will look at REITs differently. To draw a parallel, and trust me, I take my hats off to this company, and we strive to emulate what they did. But if you look at historically what Celsius did and how they were trading, and once they became profitable, how things changed for them. And I think you could take a number of other companies, but I think that's really the key. We'll continue to grow. We'll continue to drive margin. We'll continue to bring down transportation to get more efficient. But to me, it's really about profitability and generating positive cash. And I think that's really what's going to drive the stock price. And that's really what I'm focused on and working towards. Okay, well, what is the historical multiple for beverage companies on a revenue and EBITDA basis? It's mostly been revenue. I had a study done, and it averages about 3 to 4 times for revenue, right? So if we use our $60 million of last year and use 3 to 4, that's anywhere from $180 to $200 million. Multiples have come down recently, particularly in the microcap sector. I I'd like to at least be trading at 1-to-1, and that's my immediate goal to get to profitability. But 3 to 4 times historically is something that I've seen. Obviously, companies that have sold have sold more. I'm not really sure. Folks are looking at it on an EBITDA basis. I'm looking at it primarily from a revenue um, basis, and then what I've seen historically. And we've done some analysis on beverage companies, and we tend to look at smaller companies, not really the big. We take out the big Fortune 500, but that's typically what I've seen. And again, we've had our bankers do several analysis on what that looks like. But that's what we strive for. I mean, look at these are great brands. They've been around and survived for over 30 years. We'll be here for at least another 30 years, and we'll be, my opinion, a profitable company in the short term. And I think there's a lot of value there for shareholders. New question. Where can we schedule a meeting with you, Reeds, Norm? Can we book it through a conference portal or contact Reeds our team at reeds@elevate.com? I think either or. Certainly Elevate can do that, and they've done that for us before, but you can go through the conference portal if you'd like, whatever you view as more convenient. I'm looking at my timer. I guess I'm over 30 minutes, which is a good thing, but a fun thing. I love talking about Reeds. Is a very passionate thing for me. Really like, before I joined, I was a customer. I sound like the guy from Hair Club of America. Not only am I, the CEO, but I'm a customer. But I was a customer of Reeds, knew of it, worked with them in prior lives, believe in the brands, believe in Virgil's, believe in our mission. And I think we're on track, and I'm happy with our progress. We can't get there fast enough, obviously, and I'm acutely aware of that. But I really believe in our future and our plan and what we're doing, and that there's a tremendous